Hi, everyone. I'm Mike Wilkerson, founder of Stormwall Advisors, the host of Stormwall.com, and the author of Why America Matters, coming to you on the last day of June 2023. Now, for background, Stormwall Advisors is an independent strategic advisory firm serving influential leaders of corporations, governments, and other important organizations as they face their most difficult and complex strategic and financial challenges. This includes corporate strategic transformations such as merger and acquisition advice or restructuring advice, complex strategic analysis to help navigate shifting geopolitical, macroeconomic, and competitive landscapes, and policy framing for heads of state and senior government officials on key issues such as monetary policy, trade, infrastructure, or food and energy security. This is the YouTube version of the Stormwall Advisors monthly update for July 2022, which for this month is focused on a review of the year's major events in markets, inflation, the economy, and the shifting geopolitical landscape, as well as a review of what's ahead. If you're new to the Stormwall channel, don't forget to give it a like and a subscribe. Turn on the notification bell so you'll always get the latest videos, and subscribe to my weekly newsletter at stormwall.com. And of course, please share this episode with others who will get something out of it. And by the way, before I forget, thanks to all of you who have given feedback on how to make this information more useful. So let's get into it. So here we are on the last day that marks the end of the half year 2023. Thought it'd be worthwhile to review some of the really extraordinary events and outright surprises that occurred during the course of the semester of the half year. 6 months on, some of the things I predicted in January 2023 have come to pass, including persistent inflation, massive shifts in the geopolitical landscape, but other expectations such as a recession by the second or third quarter have been delayed, at least in the US, if not elsewhere, including in Europe. Now, I'm not sure they exist, but I would love to meet any unicorn that accurately predicted some of the events of 2023 so far, a semester laden with surprises, especially including a severe banking crisis, a market rebound in the face of not so great underlying economic realities. This in what appears to be a collective form of willful blindness, willful ignorance, and a spirit of, hey, let's keep dancing while the music keeps playing, at least on behalf of market participants. So for example, I mean, who would have guessed that crypto, specifically Bitcoin and Ethereum, which combined represent about 70% of the crypto market, would have been the best performing asset class, up 84, 55% respectively, in the face of an all-out assault on the industry and its entrepreneurs from the Biden administration and its enforcement arm at the Securities and Exchange Commission. Or another example, that tech would make such a roaring comeback. The FANGs are up 71% year to date, and the tech-heavy NASDAQ itself up 30% based on newfound hype and not exactly a new idea, which is artificial intelligence that has captured the attention of the markets and the media recently. Now, somewhat less surprisingly was that commodities got kicked to the curb despite ongoing inflationary pressures. Gold was ho-hum at less than 5% up, barely keeping up with the CPI inflation. Oil was squeezed down 13% year to date, but actually it's down like something like 34% from a year ago, and industrial metals overall are down. Now, to me, the biggest surprise in all this is that the market seems to be completely disregarding the implications of persistent inflation, a severe banking crisis, a debt ceiling non-deal that once again kicked the can down the road and did nothing to address the underlying problem of runaway government spending and $22 trillion, of cumulative deficits, a confirmed recession in the euro area. By the way, I assume you haven't heard much about it at all. And now what appears to be one of, if not the largest presidential corruption scandals to ever afflict the United States. I mean, who foresaw that the US would experience 3 of the 4 largest bank failures of all time, and that the surviving banking stocks, the public ones at least, would be down on price terms 25% for the year. The banking sector has proved to be so fragile, remaining standing only because of unprecedented access to emergency government lending facilities from the Fed, from the Federal Home Loan Bank, et cetera. And since depositors have left for more attractive options in money market funds and direct investments and treasuries yielding up to 5%, when the banks continue, especially the too big to fail banks, less than 5%. Now, I want to switch gears a bit, talk a little bit about inflation. We don't have June numbers as of today, but for May, what we saw was that headline CPI was down from 4.9% in April, and well below peak 9% in June 2022. However, the core inflation which excludes food and energy, was still very high at 5.3 against 5.5% the month before. And the key driver of all this was shelter being up 8%. Food was up another 6.7% on top of big numbers the year before. And transportation up over 10%. All of that offset by energy prices going down, gas down by almost 20%, fuel oil down by 37%. As I mentioned, as oil prices have fallen nearly over a third year to date. Now, real PCE did come out today. This is the Fed's famous and favorite metric. It is still high with core PCE maintaining in June 4.6% against 4.7 in May and 4.6 in April. So really nothing's happening there. In other words, we have persistent and sticky inflation in the measurement that at least the government considers to be the most important. By the way, it's worse in Europe. UK inflation is up 7.9% as of the last print of May. EU inflation for June, preliminary, up 5.5%. So again, around the world, inflation is not going away. It's becoming the bane, the thorn in the side for all of the central bankers. Now, on the other hand, in the US, the expectation is, at least for June, that it's going to come down quite a bit. I think the last consensus number I saw was 3.2%. But I want to note that my view on this has been consistent, which is I've commented before that I think inflation will go down over the course of the summer, given where we are with energy, but then start to rise again in the fall. Now, I've previously said that we could end the year somewhere between 8, 10, even 12%. I'm still in that 8+% range. I'm clearly an outlier here, but I stand on the conviction that while the probabilities have diminished, I think the thesis is still there, which is what could drive that reversal would be energy prices or a return to quantitative easing. On each of those points, I'll talk about it a little bit, but on energy, right now prices are too low for most of the producers around the world to be happy. So I would suggest look for a surprise from the OPEC plus nations, the BRIC plus nations. This will be the catalyst. You look at where we are, oil is down below $70 for West Texas, 74 for Brent. As I said, down 30+%. OPEC actions later this year will likely tighten the market in order to hit their objective of getting those prices back above $80 a barrel, even 90 or 100. Now, in order for this to be true, China, which is also suffering from some degree of recession or at least very weak economic data, is going to have to see some moves on their side. The Federal Reserve paused rates, didn't move them this last time, but they've clearly signaled they intend to. They're sitting at about a 5.25 target rate, Fed's fund rate. But in reaction to those big inflation numbers in Europe, both the Bank of England raised its rates to 5%, and the European Central Bank also at 4.25 raised theirs. So I believe we're going to see some pressure on the economy going forward, even though it's been much stronger than we would have expected, and that we're going to have some choppy waters. Why? Well, the issues are, you see it in the bond markets. The markets know that the U.S. government, the Treasury, post this debt deal, the debt ceiling deal that allowed the government to keep spending money, is now facing a wall of issuance over $1 trillion that needs to be issued in the coming months. This will pressure the markets. This will pressure the banks. On the back of slightly stronger second quarter GDP data, yields went up, yields spiked. So we see, for example, the 2-year Treasury now above 4.9%. That's near the high that we saw in March in the midst of the banking crisis, up about 65 basis points from the debt deal. Historically, sorry, I missed the point. Historically, when you see that happen, 2-year Treasury is above 10-year, and right now the spread between 2 and 10-year Treasury is a negative over 1%, 100 basis points. Historically, that's always presage recession. Will it now? Who knows? Historical patterns don't necessarily mean it'll happen again, but historically, this has been the best evidence of an oncoming recession. We'll see what happens. Now, where would the risk of recession come from? I point out Europe is already in recession. Okay, that doesn't mean anything necessarily for the US. It hasn't happened here, but are we out of the woods? Maybe, but maybe not. I look at a few things. Corporate profits have been down strongly 2 quarters in a row, down 2% in December, down over 5% in March. Headline GDP, okay, 2%, not terrible, but this is a number below the historical norms. We see that normal wage growth is now above 6%, but real average weekly earnings are down 1.5% through March. Labor productivity is down 2.7% in the first quarter. So it's not technically a recession by any means, but there's weakness. And again, the inverted yield curve appears to be the best forward indicator of what's going to happen. So and for corporates, while profit margins are above historical norms, they're falling and costs are pressuring inflation. And the reason that they're still even keeping them where they are is because the compensation is not really keeping up. And so price increases are being passed on to the consumer, but it's not being passed on to the employees. And so we see this increasing divergence between prices and how much workers and employees get to take home. And simply put, the consumer is not there. I mean, consumer spending growth is flat, confidence is down, debt is rising. And consumers, incidentally, expect inflation to rise 6%, 7% going forward. So we see a lot of things in the economy that aren't looking as good as the headlines appear. Maybe just a few other just kind of notes around what's happening around the world. I think it's interesting to see that we see almost daily news around how the BRICS nations are continuing to realign themselves together in what appears to be an almost anti-American and anti-West coalition, trying to shift the balance of power. This, I think, is a real thing that will continue to happen. It'll be negative for the U.S. economy, negative for the dollar over the long run. As I speak, over the last couple of days, France has seen very significant violent riots in almost every major city across the country. This is the second largest U.S. economy, and in the U.S. as of today, the UPS Teamsters Union, the largest single employer union in the country at around 340,000 employees, they are on the verge of a strike, having failed to reach a settlement. This actually could be, with both events, one in Europe, one in the US, have potential to grind the economies to a halt, especially if you can't ship stuff from here to there. And by the way, I think maybe you're aware, maybe you're not, but at the same time, we're right in the middle of what we see unfolding as the largest, potentially largest presidential corruption scandal ever seen in this country. What will happen from here is anyone's guess, but despite the multiple and somewhat desperate attempts by the administration and the mainstream media to kind of memory hole everything that's happened around the Biden family, Hunter Biden, et cetera, and foreign corruption and gaslighting really the public around what's been going on, the information and the evidence is mounting in such a degree, I don't know that they're going to be able to continue to hide it for much longer. So we'll see what effect that has on the markets, on the economy, foreign relations. It's hard to say, but it's not something that should be ignored as not having any potential impact on the financial markets or on the real economy. So what are the key takeaways? I'd say one, extraordinary equity market performance so far this year is unlikely to persist through the end of 2023. What we've seen the first 6 months is really extraordinary. Many people benefited from it. Many people missed out. Hard to see it continuing. Secondly, something I've said multiple times, I do not believe the banking crisis is over. Remember that there were 6 months between Bear Stearns and Lehman Brothers. Hedge funds are in a record short against the banking sector. In other words, making bets that the stock prices in the banking sector are going to fall. And notably, the bank's utilization of emergency lines from the Federal Reserve and the federal home loan banks are at a historic all-time high or near an all-time high. In other words, the banks are no longer able to rely on their customers' deposits to fund their business, their assets, and are turning to the government in levels that have not been seen even in 2008 to 2009. The next point I would want to make is do not get comfortable with the lower headline inflation numbers. I think it's fair to say we should expect that both the official numbers, CPI, PCE, et cetera, and of course, what we're really experiencing in terms of day-to-day inflation, and I've talked about why I don't think the official numbers represent the reality, expect them to track higher over the back half of the year. We're not through with inflation by a long shot. The central banks know it. That's why we're seeing rates remain high and will continue higher over the course of this year. I've said repeatedly that an inverted yield curve is the best predictor of recession. I think we're still in that area. Eurozone recession is already here, but by itself, it won't drag down the U.S., although a massive strike might. And I think the U.S. consumer weakness is really the threat. And if you look especially at the commentary that's been coming out from the U.S. public companies around sentiment, how their business is doing, what CEOs are saying about their customers, it's not great, but we'll see what that happens. And then finally, I just note that once again, we see in this environment, this disconnect between the capital markets and the real economy. Many Wall Street firms, investors will make a lot of money, but Main Street won't benefit, nor likely will the underlying companies, even though their share prices are rising, while growth is grinding to a halt, margins are getting compressed. I think it's a difficult season to enter into. So in summary, conclusion, don't get lulled to sleep by the not too bad GDP numbers, the market data, market's feeling okay. This is a long operatic drama that we're watching, and the the fat lady has yet to sing. I think 2023 is going to prove to be a historic year for a number of reasons, and really not in a good way. So I hope you found this helpful. Please don't forget to give it a like and a subscribe, turn on the notification bell to see new content, share it, and subscribe to my weekly newsletter by signing up your email at stormwall.com. Hope you've enjoyed it. We'll see you next time, and wishing everyone a great summer.